Welcome, everyone, to today's deep dive. I'm your host, and I am joined, as always, by our resident expert. And what's kind of funny to me?
What's that?
Well, we really pride ourselves on being these massive individuals. Like we curate our Spotify playlists and we customize our exact coffee orders, and we obsess over having this unique personal brand.
Oh, absolutely. Everyone wants to be one of a kind.
Right. But you put us in a room where everyone is running toward a door, or I guess more relevant to us.
Yeah.
You put us in a market where everyone is buying the exact same asset, and
And that individuality just totally evaporates.
it just dissolves.
It really does. I mean, it's what behavioral finance calls the social proof tendency. And the thing you have to understand is it's not just a bad habit. It is deeply biological.
They're hardwired.
Exactly. For like 99% of human history, if your whole tribe was running away from something, you didn't stand there and ask for a thesis.
You definitely didn't wait for a peer-reviewed study.
No, you ran. Because if you didn't, you got eaten by a tiger. The problem is that in modern financial markets, that ancient survival instinct is basically a suicide pact.
Which is honestly the perfect setup for what we are covering today. We're looking at a document today that is essentially a deprogramming manual.
A very intense one at that.
Yeah, it's titled To Counteract Social.Docs. Which it sounds super dry, right? Like some sort of mandatory HR policy.
Yeah.
But reading through this material, it feels way more like a manifesto for intellectual insurrection.
Insurrection is a pretty strong word, but honestly, it fits the vibe of the source. Because this isn't a guide on stock picking. It doesn't tell you to go buy AI or sell oil or whatever the trade of the day is.
Right, we're not doing stock tips here.
Not at all. It's more like an operating system upgrade for your brain. It is entirely designed to answer one single question, which is, how do you maintain independent judgment when every single fiber of your being is screaming at you to copy the crowd?
And just to be clear, for everyone listening, we aren't talking about the absolute basics here. Most of you already know what FOMO is.
You know you shouldn't follow the herd.
Right. But knowing you shouldn't eat the donut and actually not eating the donut are two very, very different things. The gap between theory and practice is where portfolios go to die.
Precisely. And that's exactly what makes this specific source so unique. It openly acknowledges that willpower is just garbage.
It's totally useless in the heat of the moment.
Yeah, you can't just decide to be contrarian on a whim. You actually need infrastructure. You need to build a fortress around your decision-making.
So let's build that fortress today. That's our mission for this deep dive. The source breaks this down into a few main pillars. We've got the paperwork, the psychological management, the objective rules, and then this really fascinating concept called inversion.
The inversion part is great, but we got to start with the paperwork. The written defense.
Right, the part everyone wants to skip because it feels exactly like doing homework.
It does feel like homework, but the source is absolutely adamant about this. You need a structural physical barrier between your emotion and your execution, and that starts with a written process.
It suggests starting with a checklist. Now, I know what people are probably thinking out there. A checklist. I'm an investor. I'm not a commercial pilot. I don't need a little to-do list. But looking at the items required here, this isn't just checking the price. It's incredibly rigorous.
Well, think about why pilots actually use checklists. It's not because they forget how to fly the plane.
Right, they have thousands of hours of flight time.
Exactly. They use them because under immense stress, the human brain takes shortcuts. It skips vital steps. So the source lists these absolute non-negotiables for your checklist. The thesis, the valuation, the key, risks, the time horizon, your position size.
But the one that really stood out to me from the text was the exit criteria.
Yes, what would make you sell?
You have to literally write down what would make you sell.
You have to answer that question before you ever hit the buy button. Because the reality is once you own an asset, you are mathematically and emotionally married to it.
Endowment bias kicks in.
Big time. You start overvaluing it just because it's yours. If you don't define the terms of the divorce up front before the emotions get involved, you will just hold on until the bitter end. You'll sit there rationalizing every single piece of bad news.
It's basically a prenup for your portfolio.
That is a great way to put it.
But there is a step even beyond the checklist that I found even more challenging in the source, and that is the one-page memo. The document says before you take any action at all, you have to write a one-page memo explaining the investment idea. But here is the kicker, and this is the part I really love.
Yeah.
You have to pass a specific litmus test.
This is the ultimate filter for your ideas. The test is you have to explain the investment thesis without using the words price or performance or everyone is doing it.
Which is incredibly difficult to do. Just think about how most people pitch a stock at a party. They'll go, oh man, you got to buy this. It's up 40% this month, where all the major hedge funds are piling in right now.
Right. And if you strip those specific sentences out of the pitch, is there actually anything left on the page? That's the whole point of the test. If you take away the social proof, the fact that other people are buying, and you take away the recent price action, do you actually understand the underlying business?
Do you know how they make money?
Do you understand the cash flows? If your memo is completely blank once you remove the hype, you aren't actually investing. You are just gambling on herd psychology.
It really forces you to confront your own ignorance. I mean, it's so easy to feel smart when a line on a chart is just going up and up, but it's really hard to write a coherent argument about underlying value on a totally blank sheet of paper.
And that effort, the actual friction of writing it out, is a feature. It's not a bug. If it is too much work for you to write a single-page memo, it should definitely be too much risk to deploy your actual capital.
Okay, so let's say we do the hard work. We sit down, we write the memo. We are feeling super logical and detached. But then Monday morning, the market opens. Volatility hits. The screen is just flashing red everywhere, or green for that matter. All that logic has a funny way of leaving the building when the adrenaline kicks in. The source tackles this under the heading Managing Comfort.
Which touches on something that very few finance gurus ever actually talk about, the sleep test.
Yeah, you can be totally right on the math, but if you are wrong on your stomach, you are going to fail.
Exactly. The source argues that position sizing isn't just this mathematical exercise to maximize your returns. It's entirely about making sure you can physically and emotionally survive being temporarily wrong.
Sizing it to be psychologically bearable. I think that was the exact phrase they used.
It's crucial. Let's run a scenario. Say you find this incredible opportunity, do a memo, you bet 40% of your entire net worth on it, high conviction trade. But then the broader market tanks and your stock drops 20% in a month. Right. If you are sized that large, you aren't looking at the fundamental valuation anymore. You are looking at your net worth evaporating in real time. You panic. You sell at the exact bottom.
Whereas if that was, say, a 5% position, you'd look at that exact same 20% drop and say, great, it's cheaper now. My thesis hasn't changed. I'll buy a little more.
Precisely. The size of the position directly dictates your emotional response to volatility. If you truly want to be an independent thinker, you have to size your bets small enough that your lizard brain doesn't hijack the controls. You are basically buying yourself the luxury of patience.
Speaking of that lizard brain, there's another great tool in the document for keeping it in check. And it's called the mistake log. Now, obviously, nobody likes dwelling on their failures. We tend to rewrite our own history to make ourselves look a lot smarter. Like, oh, I didn't actually lose money on that trade. I was just a little early.
We are total experts at revisionist history. But the mistake log is designed to completely stop that self-deception. The source suggests you don't just record the financial loss on a spreadsheet. You actually have to record the reasoning and the specific emotion you felt at the time you made the trade.
Like literally writing down, I bought this specific coin because I saw it trending on Reddit and I didn't want to miss out on the rally.
Yeah, ouch is right.
Reading that back to yourself 6 months later has got to be rough.
It is deeply painful, but it's totally necessary. It becomes this personalized catalog of your own vulnerability to social proof. So when you feel that familiar itch starting up again to chase some hot new stock, you open the log, you see the last 5 times you felt that exact same FOMO itch and exactly how much money it cost you. It douses the FOMO with a massive bucket of cold reality.
It's kind of like carrying around a photo of your absolute worst hangover to the bar with you.
Hey, if that helps you stop ordering tequila shots, then yes, it's exactly like that. It is a mechanical way to bypass your current elevated emotional state by appealing to hard documented data from your past behavior.
But even with the log and even with the memo, willpower just fatigues over time. We get tired, we get stressed out at our jobs. And that is where the source makes this major pivot to automation over emotion. This whole section is about physically taking the decision out of your own hands in the heat of the moment.
Because in a crisis, you do not rise to the level of your logic. You fall to the level of your training. Or in this specific context, you fall to the level of your predefined rules. The source heavily advocates for creating objective, hard criteria for your entries and exits.
Give us a concrete example of how that looks in practice based on the text.
Sure. Take valuation bands. You decide coldly and rationally on a quiet Sunday afternoon when markets are closed that if this asset hits a PE of 30, I am automatically selling half my position. If it drops to a PE of 15, I am buying. You write that down or you set a limit order. When the market actually moves on a Tuesday, you don't have to think or debate. You just execute the rule.
Which ties directly into what they call panic protocols.
Hey,
I absolutely love this concept. It's basically deciding in advance exactly how you will behave when the world feels like it's ending.
the source is very specific here, too. You need to commit to acting on objective rules rather than reacting to daily headlines.
So ignoring the noise completely.
Yes. For example, a panic protocol might be committing to rebalance your portfolio at exactly a 20% drawdown. So when that crash inevitably happens, you aren't glued to the TV wondering if capitalism is fundamentally broken. You just see the 20% threshold hit you, click rebalance, and then you log off and go for a walk.
And that walk is probably the most important part of the protocol. Because if you stay sitting in front of the flashing screen well, that brings us directly to the information diet section. The source identifies the financial media not just as a mild distraction, but as an active, aggressive amplifier of herd behavior.
They refer to it as a toxic feedback loop. During periods of high market volatility, financial media and social platforms are basically arsonists. They are just pouring gasoline directly onto your amygdala. You have to remember their entire business model is capturing your attention, and absolutely nothing grabs human attention quite like pure fear or extreme greed.
So the manual's advice is to deliberately reduce your consumption of these platforms.
Drastically reduce it. The source literally calls for a media blackout during sharp market moves. If the S&P is down 3% today, turning on a financial news network adds zero actual value to your long-term decision-making process. It literally only adds stress. The entire goal here is to isolate your own signal from their constant noise.
There is also this idea of a source audit mentioned in that same section, which I thought was a fantastic practical tip. Whenever you get a new investment idea, you have to trace the contamination back to its original source.
Yes. You have to sit down and ask yourself honestly, where did this specific idea enter my brain? Did it come from running my own screener of stocks hitting 52-week lows? Did it come from actively reading through an annual report? Or did it pop up because 3 different people in my group chat wouldn't stop talking about it?
And if the answer is the group chat,
Then you treat it with extreme skepticism. If the origin of the idea is entirely social, the thesis is already polluted. You need to scrub that idea twice as hard to figure out if there is any actual intrinsic value there, or if it is just a social contagion.
let's shift gears a bit to maybe the most insidious driver of herd behavior. We've talked a lot about fear and FOMO, but we haven't really touched on envy. The source refers to this as the comparison trap.
Charlie Munger always liked to say, it's not greed that drives the world, it's envy. And in investing, envy is absolutely deadly. You could be making a solid 8% annualized return, hitting all your retirement goals, feeling great about your life. And then you see your neighbor or some anonymous cartoon avatar on social media posting about how they just made 500% in 3 days on a meme coin.
And suddenly you're totally fine. 8% feels like a massive failure. You feel like an absolute idiot for being responsible.
Exactly. And that horrible sinking feeling of envy is exactly what pushes smart people to abandon their carefully crafted strategy at the absolute worst possible time. The source says the only real antidote to this is to anchor every single holding on absolute goals, never ever use relative ones.
Walk us through that mental shift, justifying choices in absolute versus relative terms.
Okay, so relative performance is asking, am I beating the market? Or am I making more than my neighbor? That is a game you literally cannot win over the long run because there will always be someone somewhere taking way more risk than you and getting temporarily lucky.
Right, someone is always winning the lottery.
Exactly. But absolute performance is asking, does this specific return meet my required return? Does this asset fit my personal risk tolerance and my specific time horizon?
It's the difference between running your own marathon at your own pace versus trying to sprint against every random person who hops onto the track for 50 yards.
That's a perfect analogy. You have to realize that the crowd out there has completely different constraints than you do. Maybe that guy bragging about a 500% return is gambling his rent money. Maybe he's just lying for engagement. It genuinely doesn't matter. Your required return is a mathematical reality based on your actual life goals. Envy is just a toxic distraction from that reality.
Okay, so we've built the walls, we have cut out the noise, we've silenced the envy. Now the document gets to the offensive strategy, the inversion. This is the part where we stop just playing defense against the crowd and start actually using their behavior as a tool.
This is hands down my favorite part of the source material. It argues that you shouldn't just plug your ears and ignore the crowd entirely. You should actually watch them very closely. but you watch them as a contraindicator.
But that feels a little tricky, right? Because sometimes the crowd is actually right. Like if everyone is running out of a burning building, you shouldn't invert that and run inside. You should run too.
True. But in financial markets, what we are specifically looking for is extreme consensus. When every single person agrees that an asset is a sure thing, that is exactly when the danger, or conversely, the opportunity, is at its absolute highest. The source focuses heavily on the mechanics of this. Think about it. When everyone loves an asset and the consensus is 100% bullish, who is actually left to buy it?
Nobody. The tank is completely empty.
Right. All the capital they can possibly buy has already bought in. So the price becomes incredibly fragile because the only action left for those people to take in the future is to sell. To counteract this, the source suggests a very specific mental framework called the inversion exercise.
I actually tried this yesterday with a tech stock that's been all over the news. It is remarkably uncomfortable. You basically have to look at a wildly popular asset and force yourself to ask, if this goes badly, how does the crowd's current euphoric behavior directly contribute to the downside?
That is the pivotal question. It goes way beyond just asking what if the next earnings report is bad. It's asking what happens when all these thousands of people who are all crowded onto the exact same side of the boat try to exit through the exact same small door at the exact same time.
It's a liquidity trap. We inherently think of the crowd as safety. There is safety in numbers. But in financial markets, when everyone is on one side of the
boat inevitably capsizes. And the more people you have crammed on board, the more violent that capsize is going to be. By deliberately running that inversion exercise, you realize that the crowd's massive enthusiasm is actually just stored potential energy for a future crash.
So if you see extreme consensus out there, you don't view that as market validation. You have to view it as a massive risk flag.
A giant flashing red risk flag. It tells you mathematically that the risk to reward ratio is skewed heavily against you. Even if the underlying asset is actually a good company, the trade itself is bad, simply because the positioning of the crowd is too one-sided.
Which really brings us full circle back to the core mission of this whole deep dive. We started out by asking why it is so incredibly hard to stand alone when the market is moving. And the answer is it's hard because we are biologically wired to connect and copy. But to actually survive and thrive in the markets, we have to completely rewire our approach.
We have to build a totally new structure. We cannot rely on our gut instincts. Things like the written checklist, the one-page memo, the mistake log, the panic protocols. These aren't just annoying administrative tasks to keep you busy. They are the essential scaffolding for independent thought.
And it's really not about just being a contrarian for the sake of being a jerk. It's not about hating whatever is popular just because you want to be some sort of financial hipster.
No, not at all. It's entirely about clarity. It's about ensuring that your financial decisions are actually your decisions. Because think about it. If you win big just by blindly following the herd, you won't actually learn anything reproducible. And if you lose your shirt following the herd, you won't learn anything useful from that either. You are just passenger cargo on someone else's ride. The entire goal of this manual is to force you into the driver's seat.
So as we wrap up, we want to leave you with a specific challenge.
Yeah.
And a quick warning, this exercise might actually ruin your afternoon. But it is entirely worth it. I want you to look at your own portfolio right now. Pick your absolutely biggest holding, the one you love the most, the one you always brag about at dinner parties.
And try to sit down and write that one-page memo we talked about earlier.
Yes. Sit down and thoroughly explain exactly why you own it. Detail the fundamental valuation. Detail the downside risks. But, and here is the absolute unbreakable rule, you cannot mention its recent price performance.
Yeah.
You cannot mention that everyone on your feed is talking about it. You cannot mention that the sector is currently hot.
If you strip all of that social proof away and you find yourself just staring blankly at a white piece of paper, or if you find yourself really struggling to articulate the actual core business case without relying on momentum, then you have a very serious problem.
But hey, it's definitely better to find that out right now with a piece of scratch paper than to find it out 6 months from now with your bank account balance.
Absolutely. Couldn't agree more.